Switzerland is not only a country of chocolate and mountains, but also of finance and banking. And when banks do business with each other, they do this Interbank. And Eduardo will now tell us how he uses AI to analyze effects in the market. Eduardo, welcome on stage.
Thank you for being here. My name is Eduardo. I'm a PhD student at Università della Svizzera Italiana in Lugano. And how can I change the slides here? Okay, thank you. Together, my PhD is all about to end, so probably this is one of my last conferences. It's just an amazing opportunity for me to be here. I'm pretty much in the field of social network and social network analysis. And together with Dr. Federica Bianchi and my supervisor, Ernest Witt, we came up with the idea of analyzing the European interbank market under the perspective of a social network science. So any interbank market, to be honest, actually facilitates the redistribution of liquidity among actors in the financial systems. As you can imagine, in the EU, we have a really high number of actors, a really high number of financial institutions that are interested in buying or selling excess of liquidities over the market. And as a consequence, we have really a really high number of interactions that occur in a very short fractions of time. So given this huge number of data that we are working on, the kind of like network model that you could apply to this sort of data is very limited, or actually was very limited until recently. Now, recent development in network science modeling actually allow us now to open to these larger data sets. And we set ourselves the aim to reveal how, if there was some differences in patterns in this network among the actors before and after the 2008 subprime crisis. Now, before we dive a little bit in what my old project is all about, I would like to introduce you a little bit how the European interbank market works. Now, the ECB, the European Central Bank, has a really powerful tool in which they can control the economic policy of economic and monetary policy of the EU. And it is the rate at which banks or any financial institution that can buy any sort of security that involves buying liquidity directly from the ECB. And so in this case, the ECB is indirectly setting an upper bound limit at which any bank that wants to sell its liquidity to the market. So what happens, for example, if the ECB decides to lower the rates? Now, of course, this upper bound is kind of getting lower. The excess of liquidity to buy is getting cheaper, and this actually boosts the economy. Consequently, the variability of rates at which banks can offer money in this market actually becomes shorter. On the contrary, if the ECB decides to hike the rates, buying liquidity is more expensive, and usually they do that when there is an overheated economy and inflation is not really under control at the moment. Consequently, the variability of rates in which banks can offer money in this market, can offer liquidity in this market, is actually much higher. So as we said, we analyzed the European interbank market, which essentially is a market in which cash equivalent assets are exchanged. And we downloaded data directly from the EMIT trading platform, which is a trading platform that financial institutions use to trade their excess of liquidity. I have to thank Dr. Bianchi, because she was the one that provide the data curation part. And the data comes actually in a very clean and ordered fashion, because we have the time in which the security was sold. The quarters, the aggressors quarters, are the financial institution that is offering the security to the market, while the aggressor is the one that are buying. So we focus ourselves in the period that goes from 1999 to 2015. And the reason for that is from 2011, the ECB started a policy to lower the rates until at the end of 2015, which was placed almost to zero, which consequently killed the interbank market up to recently, when the ECB started to lower the rates a little bit higher, because after COVID, well, we know inflation just got a bit more higher. We divided the data into two different phases. We have phase one before the 2008 subprime crisis and after the 2008 and after the 2008. And we propose to model these data, this sort of dynamic network, as a relational event model by the means of what we call the deep relational event additive model that we managed to publish quite recently. This deep relational event additive model that we nicely called the DREAM actually stands inside a larger framework of models called the relational events model, which are very flexible because they can be applied pretty much to any sort of different situation that involves dynamic networks. And the aim, as I said, is to provide insight to see if we can track any differences in the patterns of in the interbank market. So just briefly, how does all the relational event model work? The purpose, the input of this model assumes that we have is what we call an event that we call E. An event comes in triplet where we have a sender, a receiver, and a time in which the event occurred. Now, we can define mathematically this as, we can define an increasing process by which we count the transactions that occur for a certain sender to a certain receiver up to a point in time t. So kind of like we're counting how many times there has been a certain interaction among two different actors. Mathematically, this can be defined as a local submartingale. By a nice theorem by Dobmeier, this can be decomposed into a predictable increasing process and some residual noise martingale process. Now, relational event models try to describe the structure of this counting process via a piecewise polynomial inhomogeneous Poisson process. Very complicated name, but to be honest, what we really care about is to model the intensity function of this process. And we do that by it means of the Cox proportional hazard model. Now, if you have an experience with survival analysis or event history analysis, usually you should see here a linear combination of weights and data. We try to generalize this as much as possible because our purpose here is to model this non-linearly with some nonlinear function. Usually people use B-splines. We'll show you how we managed to do that in a different fashion. Now, but what are exactly the features that we're interested in analyzing when we analyze a so-called dynamic network? We divide the features into three different sets: monodyadic, dyadic, and triadic effects. Now, for monodyadic effects, we mean to capture what we call the heterogeneity of the financial system. Especially, we want to see the node-specific features, and for node-specific features, we mean out degree and in degree. So how many outgoing transactions can we observe at a certain point in time, and how many incoming transactions can we observe? Dyadic covariates, they capture the edge, the forming of the edges feature. And we have repetition and reciprocity. Where repetition, we can see the propensity. Actually, we can check the propensity to engage in similar transactions. While reciprocity, we want to see if there are the uprise of turning of the tables. Like a sender that was a receiver now is becoming a sender itself. Sorry, a receiver itself. And then eventually, this is a little bit more complicated, is a certain feature. The triadic covariates are a certain features that aims to capture the subclusters, the arise of subclusters in the network. So in a way, we want to see if there are sort of an arise of those little subclusters where liquidity is exchanged within just a closer amount of financial institutions. We want to track that via two different features, the ones we call the transitive closure and the cyclic closure. Now, transitive closure assesses that a certain transaction occurred thanks to the fact that there has been a third neutral party involved, while cyclic closure, well, the name pretty much is self-explanatory because we want to track if liquidity kind of goes back to the original sender. If we keep everything like this, the network has essentially does not forget anything. And if something that happened 2 years prior has the same meaning of something that happened the day before. which in some cases this is a valid assumption, but in some other cases this is kind of like a strong assumption. And in financial system, this is indeed a strong assumption, especially if we take those large time windows as we are looking at here. So we had to rescale the features by a so-called power law distribution, and the one that you're looking over here. Essentially, what we are interested in is to reweight all the features, and the reweighting occurs by choosing this alpha parameter, where if we set this equal to 0, every event contributes equally, while if this alpha is set to be a positive value, more recent events actually have a greater impact on the event that happened today. Now, following a previous study on pretty much the same topic, still about Dr. Bianchi, we set this alpha parameter to 0.5. If you're interested in doing a long discussion about how they set this alpha to 0.5, I think it involves the refinancing period of ECB securities. So we set this parameter alpha to 0.5 so that, again, we have this reweighting process happening. Now, in many statistical analysis purposes, we want to estimate things, and when we want to estimate things, we do that by the means of by the definition of a likelihood function. Now, one of my works of my PhD was actually to describe a new way of forming the likelihood of this process, and if we keep a series of assumptions, we can describe the likelihood of this process as a degenerate logistic regression, which we take for each event, for each observed transaction, we take a so-called non-event or non-transaction, something that could have occurred but actually did not. And this non-event comes from a larger set of events, which is called the risk set, that changes over time. That may sound a bit complicated, but the risk set essentially just looks at each observed transaction and checks what are all the possible combination of transactions among the actors that are in the network at this specific point in time. Now, among this huge bucket of potential events, of potential transactions, we can sample only one randomly. And if we do that and we play around with the full likelihood of this process, we can end up with this very nice reduced form of this degenerate logistic regression. Now, we want to estimate, as I said, the features in a nonlinear fashion, and as I said previously, usually in a statistical model, you do that by the means of B-splines. However, B-splines have a very huge problem that do not combine quite well when we have a lot of data. And essentially, B-splines, you go from a univariate feature to a multivariate feature because you do this matrix transformation of the B-splines. We solved this problem by implementing a neural additive model where each feature has assigned its own neural network that can be trained simultaneously, and all of them, they maximize this likelihood form. Now, we can use the Adam optimizer or any sort of different optimization technique that we know in machine learning. Adam is pretty much the state of the art right now. The only problem that we had is that, yes, we can manage to fit nonlinear effects. Still, what we as statisticians are mostly interested in is also the uncertainty around the estimated curves. And so momentarily, this is something that we're still working on, is we managed to compute uncertainty bands around estimated effects using a combination of Gaussian processes and bootstrap resamples. Then let's have a look at the results. Now, first, the monodiadic covariates. The out degree shows in the first phase, which is the blue one, that there has been almost no interesting effect happening. While in the second case, the phase 2 is showing that the more an institution borrows, the less likely it was going to borrow again. And this is highlighted by the fact that the curve, this fitness spline is actually decreasing. While the in degree, instead in the in degree, we clearly see a very different patterns in seeking additional loans. And I wrote in probability, but actually it should be written propensity. The propensity of receiving a new loan is 3 times higher in the first phase, suggesting that, well, banks are asking less money after the crisis, which is kind of interesting. Moreover, from the dyadic covariates, we can see from the repetition effect that the tendency to re-engage in similar transaction is much higher in the second phase, while in the first phase. Now, this actually is suggesting that maybe a sort of a trust and relationship system is actually arising over here, while in the reciprocity case, we can see almost no relevant differences because, well, the effects are statistically equivalent. Now, the last ones, which are probably the most interesting one, are the triadic covariates. Although we don't see any differences in phase 1 and phase 2 for the triadic closure, we can see a clear distinct pattern among the cyclic closure that shows that while in the first phase, there is not that much of an effect in the creation of those clusters in those cyclic structure, there is indeed one of these effects really much in the second phase, suggesting that yes, indeed, there is a trust and a relationship system going on after the 2008 crisis. It will actually make purely sense because after the Lehman Brothers default, well, there was pretty much a lot at stake, especially in the EU area. So to conclude, we use our little pet model, the dream model, to model transaction in the European interbank market, and we investigate those transactions by the means of 3 different set of covariates. We have spotted some differences before and after the 2008 economic crisis. We have seen a decreased propensity to borrow money, but also we have seen an uprise of what we called a trust system that is coming up after the 2008 crisis. Now, the future analysis that, although this was kind of like a side project to us, it really showed something that is really interesting about these mechanics coming up in the financial system, in this financial sector. And as a future analysis, what we are aiming to do is first to implement multiple segmentation, because as you know, the crisis in the EU area pretty much spot in with the 2011 debt crisis. So maybe by introducing higher segmentation just rather than 2 different phases could provide us some more interesting details. And to be honest, the last thing is to include what we call exogenous covariates, which means adding financial institutions' personal characteristics or edge characteristic-wise features, like, for example, the amount that has been exchanged. Right? This could be changed. This could have an effect or not before and after the 2008 crisis. For the moment, we really focus on what we call these network effects. Thank you so much for your attention.
Thank you, Eduardo, for your post-lunch talk. Now we have time for questions. There's one. Leon will bring you the microphone.
Hi. Just a question. You make some statements of comparing pre- and post-crisis, for example, decreased propensity to borrow. And apologies if I missed it at the start, but how do you control for the fact that pre- and post-crisis the market participants changed? So maybe the decreased propensity to borrow means that there are just more solvent banks left in the system.
I don't know if the mic is working. Okay. Thank you for the question. We actually are not controlling that right now. We just we are looking at only from the perspective of the single nodes that are present in the field. Now, if they are in our data set, it means they are still there, then they're not the default. But this is one of those features that we want to take care of for our future analysis. Absolutely, yes. Thank you.
A similar question. Well, the crisis banks demonstrated a decreased propensity to lend, but just by looking at the network, how do you say whether it was lending on the borrowing part that was actually, the propensity from one partner to lend to the other, or from the other to actually need to borrow? How do you discern that, because you don't have sources or sinks in the system?
Thank you for your question. Let's see if I got this correctly. So, in our model, the evaluation event model assumes that there was always a direction in which the action occurs. So there is indeed someone who is initiating the interaction and someone who is is the recipient or the receiver of the interaction. So we take care also by looking at the repetition. The repetition effect, for example, shows that there is always the same sender and the same receiver involved, for example. While, again, for example, reciprocity, we take care about the fact that the one that was a sender at the beginning now is a receiver, for example. But we always keep track of those senders, those receivers, because for us, the important thing is the direction, the flow of information, in this case, the flow of money. So that to us is what is, we indirectly control that by the way in which construct those features. I hope this answers your questions.
I think I got it, yeah.
Thank you.
More questions, please? Eduardo, if you look into other financial networks like Bitcoin, have you done that already as well? Do you see similar?
We haven't done that yet, although this actually gives us a nice way of planning future research. No, I mean, to be honest, this project pretty much came up quite randomly after a coffee break lunch. So we had this idea, and we pretty much we just recently developed this model, and we said, okay, it would be nice to see if we can spot differences. So the fact that our model spot those differences between these two phases actually gave us really nice hopes for the future. Maybe if we enlarge our databases not to involve securities only exchanged within the EU, but even outside of the EU. I don't know if this is possible. I need to probably talk with Dr. Bianchi. But I think they can, because they have securities that have exchanged overseas, to be honest. So maybe to include it in the US financial system in the way in which the security has exchanged, they can give us pretty much more information about what happened from an actual perspective after the 2008 crisis.
Okay. Well, we still have time for a question. There's one more.
Thanks. Maybe a less technical question from a less technical person, but I'm interested to know, why is this research useful? Would it drive policy change or things like that?
That's a question that I receive a lot when I give my talk about social sciences. Here is a catch. Well, first, we live in a system that is pretty much overly connected, especially from a financial institution. And by overly connected, we receive a lot of information coming from thousands or millions of different sources. Having to track the behavior of those sources, it will give us first an idea of what could happen in a context where a similar event occurs. Now, we can, although we didn't expand the data until recently, because, as I said, the interbank market died, similar analysis can be portrayed right now with the increasing of inflation and the consequences of the increased rates of the ECB or the Swiss National Bank as well. Knowing how actors behave in certain situations will tell us how the market moves, how much liquidity is exchanged. In this specific case, we can talk maybe even later about other examples of how this model can be applied. And knowing how people react, I think it's a nice thing from, well, a financial perspective, an economic perspective. Someone who wants to buy a house knows how much liquidity is actually in the system and actually knows how much their interest rate for their mortgage will actually go up or down depending on those conditions. Knowing the history of what happened in 2008, for example, knowing that potentially inflation can go up and the ECB will lower down the rates. Now, I want to buy a house in this situation or not? Do I have the financials? For example, this is just a stupid example, but this gives us an idea of how to interpret those results from our researchers. Thank you.
Eduardo, thank you very much. As a token of appreciation for your talk, you'll get some sweets. We have another 10 minutes to shift rooms, and in 10 minutes in this very room, we will talk about Edge AI again.